Net Unrealized Appreciation, also known as NUA. What is it? How does it work? If you've got a 401k and you have company stock, you 100% need to listen to this episode.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome to Secure Your Retirement Podcast. Today we have a guest with us, a recurring guest, Taylor Wolverton. She is our in-house tax and financial planning strategist. And so today we wanted to ask her about a very particular item when it comes to 401ks. And so we're going to get into that in a second. But first of all, Taylor, thank you for coming on and talking with us today.
Yeah, you're welcome.
So here's the setup. Many times in what we do in our practice, we are moving money from a 401k to an IRA. And I think, first of all, we might think, well, then why do we do that? What's the purpose of doing that? And ultimately, a lot of times we're doing it because we have a lot more investment options in an IRA than we do in a 401k. In a 401k, many times, we're very limited in what the 401k plan will allow us to invest in. That's one part. The other part is if I want to have a professional money manager, somebody to help like we do, we're not able to do that in a 401k. So I think first, before we get into this little caveat that we've invited you to come on and talk about, Taylor, and I'll just refer this over to you, Merce, real quick. Can you kind of walk through, like, what is that process? Let's not even talk about anything other than what we kind of do most of the time, what it looks like getting the money from the 401k and to the IRA and some of the tax potential implications.
Yeah. So when we do a 401k to IRA, it's called if you're working, it's called an in-service rollover. If you're not working, and then it's just a rollover in general. And what we're trying to accomplish by doing this is get it to an IRA in a place where it can be managed outside the 401k. When we move to an IRA, typically we've got more options. Your 401k, when you look at it, you may have 10 to 20 different mutual funds you can choose from. When you go to an IRA, the world of investing opens up for you, and the ability to have that managed also opens up for you. So the mechanism is that rollover. In a nutshell, we help our clients do this. Typically, it's done through a phone call or sometimes some paperwork involved with the 401k provider, letting them know we want to initiate this transaction, and we want to do it right, which means we want to make sure that it's going to the same type of account from a tax perspective. So it's a traditional 401k. We want to make sure it's going to a traditional IRA pre-tax so that there are no tax implications there. If it's a Roth 401k, which have picked up in popularity, we want to make sure it's going to a Roth IRA so that we maintain that tax-free status. And the logistics of it is typically, in most cases, a check is being sent to your house for the amount of the rollover, and then you get it over to your advisor, or if you're managing yourself, you deposit it into that IRA that's been open for you. So that's the logistics of it. A key thing here is that if you are still working, you must be above the age of 59 and a half to be eligible for this. So that's a common question too, is can I do this? How do I do this? When can I do this? Well, 59 and a half. And if you roll it out, you still get to contribute to your 401k. You still get to get the matches that you're going to get through your employer, but now the balance has moved out to be professionally managed. And so that's the process in a nutshell. Did I miss anything there?
No, I was just going to say, and then just to keep in mind, when I do this, if I've put money into a 401k and I move it to an IRA, it doesn't matter whether it's in the 401k or an IRA. If I take the money out to use it, it's going to be called income, and I'm going to pay taxes on it at whatever income rate I'm at. And so if I move it to an IRA and then I start taking that money out in a couple of years or tomorrow, whenever, and let's say I take $100,000 out, then that's going to add $100,000 of income to my tax return, and therefore I'm going to pay whatever tax rate I'm at in that particular situation. So that now I wanted you to make sure everybody was had their minds wrapped around this. But now there is this one extra thing that we wanted Taylor to come on and talk about, and it's this thing where it really applies in a limited number of ways. But if you are a person who this might apply to, it could be something for you to at least understand. And what it's called is NUA, which stands for Net Unrealized Appreciation. So now you might hear that and go, "What in the world is it?" So let me first of all ask you, Taylor, could you kind of explain who does it apply to, and what does that whole little NUA mean as far as that goes?
Yeah, so the first requirement that's important to know to even qualify for this NUA, net unrealized appreciation, you have to have employer stock inside of your 401k. So first of all, you have to have worked for a public company. Let's say if you work for IBM and you have IBM stock inside of your 401k, it's possible that you could qualify. And the advantage that NUA gives is that with that employer stock inside of your 401k, when we roll that out of the 401k, we can transfer the employer stock in particular to a brokerage account instead of the traditional IRA, as we were talking about, is more typical. Once that employer stock is transferred to the brokerage account, the cost basis of that stock is taxed as ordinary income. And then the gain on the employer stock while it was inside of your 401k can be taxed as long-term capital gains. So it's a difference in how the employer stock is treated for tax purposes in particular, and also just the type of account that it goes to. The whole point of it is to give you the opportunity to pay tax at the lowest rates. Of course, it does require, the determining what the cost basis is versus the gain and things like that. But that's essentially the goal, is to take advantage of the more, or the lower, I guess I should say, long-term capital gains rates if and when you do have employer stock in that account.
Yeah, I just
Okay.
want to say real
Yeah.
quick before we hop to another thing.
It's a lot.
I just want everybody to know that we're going to walk through some examples.
Yeah.
We're going to walk through
Yes.
a lot of different things on this. So we just wanted her to say it, and now we're going to take some time so that everybody can understand it. So I didn't want to interrupt you there, Merce, but go ahead and you can kind of start taking us down the path.
Yeah, well, I want to, I guess, clarify a couple things first. So you said employer stock. So I work for IBM and I've got a 401k. A lot of times people are just picking the mutual funds, but in some 401k plans, you do have the ability to go just buy that stock directly, right? So
And
that's
it may
the
be also through like profit sharing plans. I know sometimes like publicly traded employers, they might be giving you IBM stock or whatever the company is in place of like an employer match or in addition to that. So that could also be a possibility.
Okay, so I have IBM stock in my IBM 401k plan. So far I qualify for this thing
Yeah.
called net unrealized appreciation. And then you mentioned something around benefits on taxes. So when I just explained the 401k rollover process, that's going from 401k to IRA, but now you're saying we could do 401k to IRA and also potentially some of that to a brokerage account. So divvying up some of that, and it sounds like it could be advantageous. So can we walk through an example of let's stick with IBM. Let's walk through an example and put numbers to it so people can actually understand what you mean by moving the money out and basis. That's a fun tax term. So let's walk through a few of those.
Yes. One other thing I will say too that I didn't mention initially is that in order to qualify, you also have to either be separated from service or over the age of 59 and a half, or death is also a qualifying event. So you have to have one of those three triggers as well to even go down the path of pursuing whether this strategy is going to work for you or not. So, yes, let's go to an example. So
Okay,
let's
I'm
say,
sorry. I just
oh, yeah,
since you just said that, just
yeah,
also could I, if let's say I want to do this in service thing and I got IBM stock, can I just do the IBM stock by itself
you have IBM stock and other
and other
funds
funds?
inside the
Yep,
401k?
yep.
No, one of the requirements to receive the NUA treatment is that you have to roll out the entire 401k balance in 1 year. So if I'm going to do NUA in 2025, my 401k balance on December 31st, 2025 has to be $0. You cannot just pick the employer stock and then leave the rest. It has to be all of it together in one lump sum distribution for that year.
Okay. No more interruptions. Now you're going to go back and you're going to give us an example.
Okay, yes. So let's say we're going to stick with IBM. Let's say you retire from IBM and you're 65, and your IBM 401k balance is $800,000. And you have that situation where some of it's employer stock, some of it is just other mutual funds or whatever else you have going on in your 401k. So of the $800,000 balance, let's say $100,000 is IBM stock in particular. So we call up IBM's 401k custodian, let's say it's Fidelity, and we ask them, what is the cost basis of the IBM stock in this 401k? The cost basis is going to be the value of the stock when you purchased it initially in your 401k, or if it was like a profit sharing from your employer, then the cost basis is whatever the value was at the time that you received that stock. So we call Fidelity and they tell us that your cost basis of the IBM shares in your 401k is $40,000. So it's a $100,000 value, $40,000 is cost basis. That means there's about a $60,000 embedded gain in just that IBM stock. So in order to pursue the net unrealized appreciation, what we would have to do is send the $100,000 of IBM stock to a brokerage account. The other $700,000 balance in the 401k has to go to an IRA. So two different accounts, two different distributions, but we've gotten all $800,000 out of the 401k, which is a requirement. Like I said, it has to be a total distribution in that year. And then the advantage that we're going to receive as part of this NUA is that, like I said, the $40,000 cost basis that's going to the brokerage account, that is taxable as ordinary income in the year of the transfer. So that's important to be aware of and to be prepared for. But the advantage, I should say now, is the $60,000 gain, instead of being treated as ordinary income, is now going to be taxed as long-term capital gains whenever it is that you choose to sell the stock. You do not have to immediately sell the stock. You can just keep holding it in that account until you want to sell it or need to sell it for income. So it separates, instead of the entire $100,000 of employer stock being taxed as ordinary income, like it would if you were to just go the traditional route and go to an IRA, it separates the cost basis being taxed as ordinary income and the gain now being taxed at the lower long-term capital gains rates, which is essentially what we're after by doing this anyway, is getting the long-term capital gains treatment on the gain of the employer stock.
Okay, so let's continue this example and let's
Yeah.
just go down that math and let's just do a hypothetical on what my tax would look like doing this. Let's just give it a real example of what my tax burden would look like on this.
Yes. Okay, so let's start with, let's say we just go traditional route. We take the entire 401k balance, we send it to an IRA. Let's say you're going to take a $100,000 distribution, and I'm just going to say, let's put you in the 22% marginal tax bracket. So that means if you take a $100,000 distribution out of your IRA, you'll pay 22% federal tax. That's $22,000 federal tax bill. So keep that in mind. In comparison to if we go this NUA route, like I said, the $40,000 cost basis is now going to be taxed as ordinary income. So that will be taxed at the same 22% rate. That's $8,800, 22% of $40,000 cost basis. But the $60,000 gain that was on the IBM stock will now be treated as long-term capital gain and taxed at 15%. So 15% of $60,000 is $9,000. So when we pursue this NUA route, we have partial ordinary income, partial long-term capital gains. Total federal tax bill is around $17,800. So that's the goal, is to get the $17,800 NUA route tax bill lower than the traditional just going straight to the IRA, not looking at NUA at all.
Right. So in your example, and it really, I think, comes down to education and kind of understanding that this rule even exists, and then understanding whether or not you qualify. But in your example, if you aren't aware of it, or and you just move it to the IRA and you take the 100, you pay 22,000 in taxes that year on the distribution. Whereas if you did it the NUA route that you're explaining, you pay 17,800 or almost 18,000. So $4,000 savings on just having knowledge around this particular strategy.
Yeah.
So to go back. So first you kind of say, hey, do I qualify? Do I have stock in my 401k that's publicly traded? And then you say, do I want to do this to get this long-term capital gains treatment? But now the qualifier is am I ready to do this in the sense of, am I able to afford adding on
Yes.
what would be the basis to my tax return? So in your example, that $40,000 of additional income to accomplish the NUA. And then you got to justify, is it worth the long term? Is it worth it to get the long term capital gains treatment on a portion of the money? Um,
Yes, exactly.
so a couple of things to think through, and I would think most would want to have a conversation with a tax person or a financial planner that understands NUA. But
Wonderful.
yeah, let's walk through the goals of this, and when do you do it? When do you not do it? What scenarios can you think of?
Yeah, exactly. So of course you have to make sure that you qualify. And like I said, the goal is to pay the lowest tax rate possible. In that example where the IBM stock was sold and the long-term capital gains rate was paid on the gain, you don't have to sell the stock immediately. I was just saying in that example, just for the sake of trying to get to the apples comparison, we sell the stock. But like, I just want to be clear, you can keep holding that stock for as long as you want. So when it is worth pursuing is when your cost basis is low in comparison to the total value of your company stock. If in that example, the IBM stock, again, we have $100,000 and our cost basis was like $85,000, $90,000, you're going to have to pay ordinary income on that $85,000 or $90,000, whatever the cost basis is, and then the remainder being the long-term capital gains. If the long-term capital gains portion is not the majority of that value, then it's going to be more difficult to justify paying the ordinary income on the cost basis in comparison. So it definitely needs to be a conversation that is had of understanding what the tax implications are, what is the cost basis of that stock in comparison to the total value. And if the cost basis is low enough to make it worth it, that's really what this decision turns on. And then it's not required, but kind of related to that, it would be ideal if in the year that we do this NUA distribution, your other income was low so that you could be in a low ordinary income tax bracket to justify, again, that tax bill that you will have on the cost basis of the employer stock. So if it's going to put you into a high tax bracket, then it's possible it's not even going to be worth pursuing. Or if it's, a situation where you just don't want to pay the tax bill on the ordinary income, then maybe we don't pursue it either. So definitely the taxes need to be discussed and prepared for to make the decision on how it's going to be best to pursue or not.
Excellent. So yeah,
Um,
go ahead. Is
yeah,
there
I was
something?
just going to say one last thing is
Yep.
getting the employer stock out of your 401k because it's now in a brokerage account. Brokerage accounts do not have required minimum distributions where traditional IRAs do. So just one other advantage to doing NUA is that you're not adding even more to your 401k and IRA balances. You're taking that out, and that takes that employer stock out of the equation for your required minimum distributions later on as well. So that can be an advantage. But again, I would say the bigger piece is what the consequences are going to be in the year that the distribution is taken.
Okay. Excellent. So I just would kind of want to sum this up. I think that
Yeah.
the goal of what we wanted to do today is to let people know if you have stock in your 401k, have a conversation about whether or not the NUA applies, well, whether or not you should employ it. Let's say it that way. It applies to you, but whether or not you should employ it, can you employ it? Is it worth it? So basically just saying, hey, let's just do an analysis on it and say, does it make sense? That way you've made an educated decision, because what you don't want to do is move your 401k, then find out about net unrealized appreciation and go, my goodness, should I have done it? And
Mhm.
it doesn't really matter the answer because we've already done it. So let's don't beat ourselves up. But We just want to make sure that hey, if we address this ahead of time, you get to make the decision. It's going to be, you're making an educated decision, and that's what we want. So if you were working with us as our firm, Taylor's going to do that analysis, and she's going to hey, here's the numbers. Does it make sense? Yes or no? You get to make an educated decision. So thank you very much, Taylor, for coming on. And we love having you come on and you explain the most riveting things and NUA. So no, it is something that we need to know about. And so we appreciate you coming on and explaining a topic that it can be complicated, especially to be listening to here. But by the way, just on that point, if you listen to this and you're like, what? I can't remember all these numbers. A couple things keep in mind. We do have a blog that is written on this topic, so it'll have all those numbers and examples in it. So don't worry about that. And then we also have a lot of show notes if you go to our podcast page. So we'll have it all laid out there for you. Thank you very much, Taylor. We appreciate it.
Yeah, you're welcome.
We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.